And I guess the question is a kind of big picture one here. I'm seeing the Chinese having to step in to provide stimulus for their economy. The Chinese economy was well ahead of everybody else, and I'm just trying to understand the pace at which this cycle is operating at. As the Chinese step in, can I assume that the US economy or the European economy may need similar sort of stimulus to keep the growth trajectory on track in 6 months, 9 months, 12 months' time?
Yeah, it's a complex question, isn't it? And I think we have to separate the two things. Like the point you make is right. China was first into COVID. It was first out of COVID. It was first to start taking back the stimulatory measures. What we're seeing now is a bit of a correction, because one of the things that has been very concerning about the China outlook has been the slowdown in the credit growth, the so-called credit impulse, which tends to lead Chinese growth by 3 to 6 months, which is pointing to weaker growth conditions ahead. What they've done with the RRR is an important indicator that maybe we're starting to see that stabilisation in credit growth come through, which is important for next year. Now, you were talking about the this year's growth forecast for China. Next year's growth forecast is arguably more important. The consensus is looking for around about 5.5% GDP growth. The risk has been that credit growth continues to slow. We see sub 5% GDP growth in China, and that would have a lot of implications for asset prices and economies around the world. I think that we're seeing stabilisation. I'm confident that we'll get that 5.5% growth number. I think today's move is very important. In terms of what it means for the other economies, it just means that they can continue on as is. A big risk for Europe, of course, is that if China continues to weaken, China being such a big growth engine for the world, and Europe, relative to the United States, being much more exposed to the global economy and having a much bigger export sector, it was a risk that if China does continue to weaken, that puts a dampener on Europe's growth outlook. But I think the news that we've had this week is quite significant in terms of seeing where the inclination of policymakers in China is going.
Andrew, it's interesting. I've heard a lot of analysts bullish on EM, given those high growth rates that you just cited. I am wondering, though, that within EM, are you looking at EM ex-China, given some of the headline risk out of Beijing this week, maybe the crackdown on some of the regulatory measures around their big tech companies?
Yeah, that is an issue, and there's two regulatory issues to watch out for. There's the one on the tech companies, and also the regulation that's coming through in the shadow finance sector, which could actually affect the credit growth numbers. And the challenge with being bullish on China is, apart from the domestic slowdown that we're seeing right now, is the fact that the Chinese market is so heavily tech represented. But a lot of the broader EM outlook comes down to two things. How does the vaccine rollout progress? And so far, the evidence is that we're seeing an accelerated vaccine rollout across a lot of the major emerging market economies. So that's good news. And the second always important factor when you're thinking about the emerging market outlook is what is going to be happening to the US dollar. And part of the reason why we've seen this tightening in financial conditions across a lot of the other EM economies through the past quarter has been because of that rise in the US dollar. The US dollar was falling before that. And if it continues, if it resumes that downward track, which I think it will if the Chinese growth story comes into play, then I think that will take a lot of pressure off those EM economies.
Andrew, I want to kind of think about what has happened this week in terms of the move we've seen in yields lower both in Europe and in the United States. And again, kind of relate it back to what we're seeing in China. As you say, they tightened credit. They're now having to course correct because of that tightening that they've delivered. You're starting to see a similar thing with the Fed. You could argue that the Fed has already started to taper. You see what it's done in the credit markets. And again, I'm wondering what you make of the price action this week that we've seen, and whether or not that is a reflection that the market is worried that the Fed is in danger of making a policy mistake.
Yeah, my take is the market is overanalyzing where the Fed is right now, and the market overanalyzed what happened with the dot plots. What we're going through right now is pretty straightforward when you step back. We've had a very big recovery, initial recovery out of the lockdowns. We're now heading to an inflection point. We're seeing growth decelerate across most of the major economies, but it's decelerating to still a very strongly above trend pace. And that's quite complex for markets to deal with. We had the surprise with the dot plots to seemingly move more hawkish. But I think when you think about where the Fed is right now, nothing that's come out of any of the comments made by Jay Powell suggests that his views have turned much more hawkish over the past few months. So the Fed, I think, is still on the slow track. The market has been a bit overanalyzed those dot plots. And I think that we're still probably at least 18 months to 2 years away from the Fed actually doing anything meaningful on monetary policy. And by meaningful, I mean actually raising interest rates.